The alternative asset management industry is growing and will continue to grow. More and more LPs are looking at this space to complement their exposure in the private markets. The deal makers are at the table with the capital, and the capital wants their money closer to the deal, if you will, and they're far more involved and far more aligned at this early stage of firm development.
My name is Clark Edlund, partner here at Kaz Investments, and I'd like to thank you for joining us for our third Thursday Themes conversation for this month. Today, I'm pleased to be joined by Elizabeth Weymouth, founder and managing partner at Grafine Partners, which is a specialized investment firm focused on sourcing off-market direct private equity deal flow for sophisticated pools of capital around the globe. Elizabeth, thank you for joining us, and we appreciate your time. Perhaps you could get us started. You could give us a brief overview of your firm and its investment strategy.
Terrific. Well, thank you, Clark. I'm delighted to be here, and I am delighted with the ongoing partnership that Grafine has with Kaz Investments. I started Grafine Partners a few years ago, really in the context of a growing and maturing alternative asset management industry. I noted that as the big firms got bigger and as their funds became bigger, sometimes the returns were compressed. And at the same time, there was a group of investors who had become only more sophisticated, having dealt in private markets for longer, who were looking for private markets alpha in the context of perhaps increasing private markets beta. These investors were looking for unique off-market private deals. And as I looked into how this group was sourcing this unique deal flow and this direct access to either management teams to build companies or to investment teams that they had been disintermediated from, I found an opportunity to create a firm that really didn't exist to fill the white space, that has the mandate to go across the globe, across industries, across sectors, find this best-in-class source of direct deal flow, and then importantly, apply a very institutionalized investment process that we can get into. But one of the sources that we've identified of alpha, if you will, in the market today is taking advantage of a trend that's also happening as the industry matures, and that is that some really talented investors are spinning out of the bigger firms and creating new firms. So part of our strategy, Clark, is to find these rock stars, as I like to say, with terrific track records and help put them in business, seed them, if you will, de-risk that startup and get this deal flow for our investor base.
Thank you, Elizabeth. That was super helpful. So obviously our firms have really been investing together since day one at Grafine. And as you know, because, well, you've likely heard us say it a couple hundred times by now, but we as a business, we always start with the downside discussion first, because we believe if we can get comfortable and live with that true worst case scenario, the upside more often than not typically takes care of itself. With that in mind, how do you guys think about what that real worst case scenario looks like for the strategy and for your approach?
It's a great question and something we think a lot about. And in fact, if I think through the structure of our fund and the way that we invest in these new managers, we've taken risk mitigation into account for every single decision. So first and foremost, when you think about the firms that we're investing in, I think the group that we're looking towards is actually a de-risked group. So this is a group of investors now. It's very different now in the market than it has been in the past. These individuals have 15 to 20 years of experience investing usually within a certain sector with a track record you can verify. And now they've developed this cohort of management teams and CEOs from whom they generate unique deal flow or alpha, if you will. So having someone with that background, I think, is an interesting way to really partner and get access to unique deal flow. The phrase, I guess, of emerging managers has changed radically over the past decade or so, as we have a situation today where more than 50% of the alternative asset management firms and private equity firms in particular are over 20 years old. So the people within them have substantial track records. When they start to spin out, they're not just a newbie to the private equity industry trying to start a new firm. These are people that are seasoned and have professional background. So I think that's one part of a de-risking conversation, Clark. The second is that we put more than one manager, obviously, within a fund. So we have a concentrated portfolio of around 5 to 6 different first-time funds that we have backed within a context of a Grafine Capital One. First-time funds, I think I didn't say this at the outset, but I think it might be, it's certainly inherent to our strategy, and it perhaps could be obvious now that people know a lot of the statistics, but first-time funds outperform non-first-time funds, and they have every single vintage year for the last 20 years. So if you're looking for alpha, this is a really interesting group. But to your point about risk, what could go wrong? Well, in what we have found in emerging managers, as we look through different case studies and throughout history, it is rarely the investment that goes wrong. Keep in mind, when people are starting a brand new firm, they are really leading with these great deals, which is why it's very interesting for us to back them. So these are deals that have outsized return potential, and this group the group of investors will actually do whatever it takes to get that extra turn of capital at this early stage of their development. So it's really not the deals, but I would say that the thing that we worry about is really the formation of the partnership and the founding partners. It's the business, if you will, because very rarely has this group been involved in building an institutional quality investment firm. But we built Grafine with a team of 15 people that have all had experience in this realm of building up multi-billion-dollar alternative asset management firms. So we are very hands-on in ensuring that we can try to mitigate that risk.
Yeah, look, I think it's a great point that you made that emerging doesn't necessarily mean new, right? More
Correct.
often than not, these are highly experienced teams just kind of planting their own flag, maybe under a new structure, a new brand, new banner, if you will. On a related note, what in your opinion is kind of the biggest challenge or headwind facing just like the market or the strategy more broadly speaking?
No, it's a great question. In fact, the challenge can become the opportunity, at least as far as Grafine's business model is concerned. But the fundraising market has been incredibly challenging for all, and that's across the board in the alternative asset management space. The quest for DPI still remains a vast concern, and so it's impacted how LPs are committing to new firms. I think the statistics are last year alone, more than 60% of the capital that was raised in the alternative asset management industry went to the top 6 by AUM funds, and therefore firms. So it's just there's a gigantic gulf between the top funds and the biggest AUM growth firms, and then the new, even middle market firms that exist today, and then the newer firms, of course, even more difficult for them to get capital. What's interesting, Clark, is though that has not stopped people from the American dream of entrepreneurialism, since we're focused largely on the American GPs. We do have an outpost in London, and we do have partnerships in Western Europe as well. However, this entrepreneurial streak is occurring still, despite the fundraising market. But that becomes a challenge, that challenge, I should say, becomes an opportunity for Grafine, because what we come in is to provide a solution for these folks who are launching new firms. And we can be not only a capital solution to get them going, but also, as I mentioned earlier, our team can partner up with the founding team, roll up our sleeves, work day in and day out to help de-risk this startup, but really put them in business. And hopefully we accelerate their growth by, I don't know, 3 to 5 years or so. Hard to put a number on that, but accelerate them and launch them into hopefully a successful future that then has them growing their firms and, really falling into an interesting target category for middle market GP stakes firms and more the large cap GP stakes firms.
That's helpful, and I don't want to put words in your mouth, but given we're in the early innings of a new administration, rates feel relatively stabilized for the time being. We have escalating global tension between and within regions, and just how messy and polarizing so many other issues are right now. It doesn't seem to be a pressing or overly impactful issue for your business specifically. I mean, do you see any of these just overly exogenous factors creating any unforeseen challenges or unknowns for your business?
I think in the investment environment broadly across all of private equity and arguably alternative asset management, these things need to be taken into account as you think about investment cases and different scenario analyses and the opportunities that exist in a variety of sectors. So we certainly won't ignore these factors. However, from a launching of a new business in the alternative asset management industry and private equity in particular, and we are focused incidentally on lower middle market and middle market private equity firms. That's where we think the alpha is being generated in private equity right now. We haven't seen well, it's a new, it's new administration and we're in early innings, but we haven't seen that impact the launches. In fact, we are up to reviewing 5 to 7 new opportunities per week. Since we've started Grafine, we have seen over 860 different teams that wanted us to back them in a variety of fashions and a variety of sectors within the alternative asset management space. So the supply continues and it's really robust. And I think that now the LPs are starting to adopt this group as a genuine group that can provide much needed alpha to complement the larger exposure to private equity firms that they have in their portfolios. So I feel that there are tailwinds to the thesis that we have.
Just to double click on that for a moment, because I think it's important. If you were to look at that pipeline curation, what are the sources of that pipeline curation, and how do you guys think about that?
It's really been something that as we reflect on where our deal flow is coming from, I've been incredibly gratified actually, because as we target where things have actually emanated from, it's from the network. And so at this stage, the team of Grafine, we have some seasoned professionals that have over 30 years experience as being founders of private equity firms themselves, or being in founding partnerships. And that combined with our advisory board and others has really been responsible for a lot of the access that we have. We find that we're meeting new firms before they're thinking about launching formally, so we have an early look there. But as our name becomes known out there a little bit more, I think we are starting to see other industry participants call us up out of the blue, and so we are seeing new folks that way. But everyone we have actually backed, someone in our network has worked with that team or a person in that team over 10 years or more. So that gives us a lot of comfort, if you will, when backing a new team.
Thank you. And perhaps that's a great segue to pivot to the more optimistic end of the spectrum. And given we have mutual optimism around this part of the market, what would you say is the biggest tailwind from a macro perspective, in your opinion?
I think that the maturation of the industry as it goes and continues is really an incredible tailwind that I don't think I fully appreciated when I started Grafine. When I was thinking about Grafine, I have my own experience at some of the larger cap firms. So I was thinking that the spin outs of these new teams were occurring at the biggest mega funds, if you will. But quite frankly, and these are 300 billion or more of AUM, there's another tier of 100 billion or more AUM firms that are moving up in AUM sizes and becoming older firms, and people are spinning out. And then there's another tier after that of 50 billion or more. So I think that this opportunity set that we had, that I had identified early on as sort of the biggest firms would be the candidates, it really is across the board and across the globe. So the opportunity set, of course, is in the US where we have focus, Western Europe, as I referenced, but I think other geographies are equally interesting for us to look at. And then I think that the focus of the teams is really interesting. So while every single deal team and managing partner group that's starting a new firm has their own equation for value creation within the sector that they have been focusing on for their whole career, all of variables are usually different as where value creation can occur in different sectors. However, one thing we've noticed, the same variable has popped up in every single sector, and that is technology. So this generation of private equity leaders starting new firms are using technology, whether it's sourcing of the deals, value creation within the deals. So it's just a very exciting time, I think, for people to have a little bit of a twist on a new philosophy of how they're going to make money in the current environment.
Yeah, it's super helpful. And you know, you spoke about technology as a specific example there, but maybe even to get a bit more granular, and feel free to use a case study or an example to the degree that you're able to do so. But what would you say you're most excited about, or perhaps maybe something that just could really surprise investors to the upside that they weren't expecting otherwise, whether that's technology or some other ingredient?
I think that, well, I would almost take a step back again, Clark, and say for this particular group who are becoming the next generation of private equity leaders, I think the innovation occurs in many fashions. So yes, we mentioned technology and the use of technology in the investment process and the value creation process. But I think that the way that this group is thinking about partnerships with investors as true partnerships and a lot of alignment in the structures of their deals, of the funds that they're creating. You know, we're actually creating an environment, I believe, where the deal makers are at the table with the capital, and the capital wants their money closer to the deal, if you will, and they're far more involved and far more aligned at this early stage of firm development. And this true partnership, I think, is a game changer. So it really is in not to say necessarily contrast, but as the big firms get bigger and they have so many more investors, it's a different dynamic than what we're seeing at this early stage of new firms being formed and lasting partnerships with capital, where it's a true partnership and completely aligned. So I think that's an exciting point for this group that's really focused on innovation while creating, you know, outsized returns.
Yep. So you mentioned this prior, and we talk about it in our quarterly letter as well. But you know, in our opinion, the space is poised incredibly favorably going forward, given we've seen this massive pendulum shift, and you know, the denominator effect in terms of institutional pools kind of reopening the spigot and re-upping and making new commitments, which really didn't happen in 23 or 24, mostly as a result of just poor performance from traditional assets in 22, and just, as you said, lack of distributions or DPI to investors for really what's been a few years now. And then lastly, we've seen this meaningful year-over-year increase in M&A activity, and IPO markets seem to be softening as well. All of these things are obviously positive for just capital flow throughout the ecosystem. That said, on a scale of 1 to 7, 7 being the best, 1 being the worst, how would you rate the current risk reward in your sector? And feel free to break out how this response may differ across strategy, asset class, or geography, if your sentiment is in fact meaningfully different between any of those factors.
No, it's a really good question. I'd have to say, I think I rank it around a 6, because I think it would hard to say anything
I like it.
A perfect 7. But you know, I think we are in a place that is just beginning with respect to adoption of the LPs being willing to entertain sort of first-time funds that for years and years, and for many large investors, still the case that some people just will not entertain partnering with a brand new firm because of the risks we talked about. They'd rather see the firms as they mature. But because of the very compelling return statistics and the fact that's intuitive that these managers will do whatever it takes to have a very successful first-time fund so that they can have a second fund and beyond, I think that the more and more LPs are looking at this space to complement their exposure in the private markets. In earlier days, it was, you know, more family offices or endowments or foundations or other sort of nimble and you know, looking for alpha, seeking alpha, willing to take a chance on earlier managers that would be attracted to the segment. But now we're seeing big pension funds support emerging managers. We're seeing larger pools of capital get into the game, and that's very positive for our sector. And I mentioned earlier the supply that we've seen, and we're a relatively new firm, is extraordinary of opportunities to partner with talented deal makers. So I believe that there are tailwinds behind us as we think about the opportunity set of these new managers who could be the future private equity leaders. And I think there's alpha to be had across sectors, across geographies. And I think the structures that we are putting together at Grafine to access these types of investments, whether it's the manager themselves in the fund or co-investing alongside of them, we're providing a broad platform, if you will, to access deal flow from this cohort of people who are super talented and have a long history of doing wonderfully in the investing markets. Now they're launching new things, and Grafine can get in at that inception point, help them, and our investors can get access to those deals.
Tangentially to that, and as adoption is becoming more obvious across different pools of capital, what do you experience or what do you think people are getting wrong or maybe not fully appreciating enough about the seeding space specifically, given it's kind of that 3.0 within that stakes, capital deployment and life cycle for management firms?
Well, I think, there has been a hesitation from many investors to look at this earliest stage. You could
Yeah.
say that this is sort of the venture or the incubator part of the alternative asset management industry, because we're out there scouting for talent who are creating brand new firms. Granted, these brand new firms, the ones that we are investing in, the funds of, they're investing in EBITDA positive companies and middle market strategies, as we discussed, but the firm building part of this is something that has really, caused investors to say, maybe in the past, I'll wait a bit. Our perspective is we bring to the table something to de-risk that group. So the 15 people we have at Grafine, fully half of the team has had 30 years or more direct investing on the private equity side experience, and the other half has had experience in one form or fashion building up a multi-billion-dollar alternative asset management firm. So if we can go in and help de-risk that part that investors have previously been worried about, I think that's value add. And then we talked about the alpha that's possible in this particular sector. And I think that the LPs are now, with enough history, and we have more than 20 years of it, of outperformance, they're buying into that. And so then I think it's all about how the partnership goes. So seeding and the way that it works for our investors, very much like the GP stakes arena, has two sources of return for investors in the way that we've structured partnerships. First and foremost, hopefully we're backing people with great track records that are going to generate the alpha at the deal level, as we talk about. But secondly, whether it's revenue shares or a GP stake or some other form of alignment between the capital and those that we put in business, investors get the benefit of the firm growth in addition to the returns that they're getting from the deals. So if we at Grafine are doing our job properly, we're identifying these firms that build and grow, and then we de-risk them and hopefully send them up the food chain, if you will, to middle market stakes firms or large cap stakes firms that exist.
I'm curious on this. Something we get asked about frequently is where do stakes or seeding allocations, where should they live in a portfolio or an asset allocation? How do you and your team typically respond to that?
We think of stakes, so your both stakes and seeding agree with the thesis that the alternative asset management industry is growing and will continue to grow. And so I think that is indisputable. There's a lot of data that we can all access that shows this to be the case, and anecdotally, we certainly feel that. So as the industry grows and matures, to be a true partner at the GP level and the GP stakes and take advantage of that, in addition to the returns one gets from the portfolio, I think is a very savvy way to invest. And it becomes, maybe it's a hybrid, Clark. You have the private equity exposure. We're talking about private equity. And then you have also this fixed rate of cash flow coming out that looks a little bit like a bond or a fixed income instrument.
Indeed.
So it's a bit of a hybrid, but squarely in the alternative asset management arena, perhaps a little bit de-risked, if you will, because of the cash flow component. In the seeding part, because of the combination of either rev shares or GP stakes, it's just an earlier stage version of that same thesis, that as the industry grows and matures, the larger GP stakes firms are taking advantage of that substantially. And maybe the tilt in an earlier phase is more towards some of the returns on the portfolio companies themselves, but a very healthy component of the return is also this participation at the management company level or the revenue level.
Yeah, it really is an interesting dynamic because it checks so many different boxes. It can live in so many different parts of the asset allocation conversation, which I guess is a little bit probably more of a blessing than a curse. But you're right; it's got characteristics that look like credit that also are clearly, obviously, equity. So it can live in a lot of different places. As we close, lastly, just make a quick case for why you believe your strategy or theme to be a better alternative than maybe traditional asset classes, and maybe not necessarily just better, but perhaps complementary to traditional asset classes and other staking strategies, more broadly speaking.
I would say complementary, Clark. You hit the nail on the head with that, because what we at Grafine identified was actually a pretty big white space that exists for the sophisticated investor who wants to access unique off-market deal flow from the source, and then the source being a proliferation of new firms that are being launched by investors who are seasoned and who have extensive track record. So I believe that as we think about the asset class, we think about the fact that these are early firms. Early firms do outperform for I think the obvious reasons. And as long as they're de-risked, that's where you can get exposure to managers that you might have in your portfolio for decades to come. So in our world, finding this group, sourcing them globally, diligencing them deeply. We reflect that we've not really forged any partnership yet at Grafine that is less than 7 to 8 months of diligence and structuring. And then we'll structure the investment creatively to help mitigate risk and to protect the downside while offering investors upside as well. We invest ourselves, and then we curate capital alongside us to build these companies together. So I do believe it's a differentiated model. I think we live a little bit between a traditional GP and a traditional LP in our approach to the industry. But I think the way that we've thought about this and the way that we're executing does provide our investors with access while having a foundational floor beneath them to mitigate the risk of just doing a one-off support of a one emerging manager or getting a one-off deal that you have to wonder, who said no before that one-off deal came to you. So I think that we're able to plant a flag, be a source of really talented investors out there, and that complements usually the exposure that our investors have already. But we haven't seen too many other people doing exactly what we're doing the way that we're doing it.
Indeed. Elizabeth, this was incredibly helpful, and as always, we appreciate the insight and support from you and your team. Thanks to everyone for joining us, and please join us again next month for our next conversation.
Thank you, Clark, and thank you to the CAS team too.